So in this session, we look at a ratio which measures the short-term liquidity comfort of a company, which is the current ratio. The formula for calculating the current ratio is fairly simple. It is current assets divided by current liabilities. Now, what does this ratio indicate? It indicates in percentage terms the working capital with which the company conducts its business. Current assets include cash and liquid assets that can readily be converted to cash, such as accounts receivable, inventory, marketable securities, prepaid expenses. As a thumb rule, any assets which can be converted into cash within a period of 1 year or less. Current liabilities are obligations of a company which are due within 1 year and include short-term debt, accounts payable, accrued liabilities, and other debts of similar nature. Now, a high current ratio means a higher short-term liquidity comfort level. However, keep in mind that an extremely high current ratio may actually indicate that the company is not utilizing its current assets in an optimum fashion. In other words, it indicates that the company has too much current assets or free cash lying on its books which is not being utilized in an optimum way. A current ratio below 1 shows that the company may not be able to meet its obligations in the short run. This is when the current assets are less than the current liabilities. However, this is not always a matter of worry, especially if the current ratio temporarily falls below 1, as companies often squeeze out short-term cash resources to achieve a capital-intensive plan with a longer-term outlook. So here in this example, we have this company with current assets of 1.5 crores and current liabilities of 1.2 crores, which gives it a current ratio of 1.25, which is current assets divided by current liabilities. It's above 1, so it's good. But it's not always the case that if it falls below 1, it's bad news for the company. So let's say that this company finds a beautiful expansion plan in the form of a new plant or land which it can acquire at a price of, let's say, 3 crores, which is at a 50% discount to what the company would be happy to pay for it. Now, in such a scenario, of course, the management will squeeze out all the short-term cash and may even add additional funds by taking a loan. Their intention would be to acquire the asset while it's available for a discount. So if all the current assets are squeezed out, meaning if this entire 1.5 crore gets squeezed out to acquire this new asset, the current ratio may fall to 0. Now, is that such a bad news for the company? Maybe not. Here was a company which was able to acquire an asset while it was available for cheap and momentarily felt a liquidity crunch. What you have to be sure of is that this liquidity crunch is indeed momentary, and the company is not genuinely facing any liquidity problems. So the thing to keep in mind is that while a company should have a healthy working capital, in case there is a liquidity crunch, you must find out the reason for such a situation. And only then you can conclude whether the liquidity crunch is in fact genuine or not.